there's really only one way that this can end for the metals, and that's at much higher prices. And eventually, as people start to understand, they're going to be buying these gold mining stocks and silver mining stocks. I mean, the outlook has been way too pessimistic for a long time because the mainstream analysts that cover these stocks don't understand the monetary situation. They don't understand inflation. They don't understand fiat money, central banks, economics, you name it. They're pretty much ignorant of it. And so, that affects their coverage of these stocks and how they recommend them to their clients. I think that's going to change. People are going to start to appreciate what central banks obviously have already figured out, which is why they've been such big buyers.
Welcome back to Metals and Miners. I'm your host, Gary Bohm. Today, we're digging into the resilient and exciting world of gold and silver with Peter Schiff, founder of Schiff Gold and Europac Asset Management. Peter, it's an honor to have you back on Metals and Miners. Welcome to the show.
Oh, well, it's my pleasure to be back on the show. Thanks a lot, Gary.
Okay, so Peter, you've been around for multiple precious metals and market cycles. You have a long history of correct calls on the markets, metals, and the miners. For most, being in this actual cycle, it's a whirlwind. It leads them to rash and often incorrect decisions and even psychological and emotional confusion. What do you hope for those tuning in to this conversation today that they will walk away with after listening to this discussion?
Well, I mean, if you're investing in the sector, just to recognize the nature of what's going on, and not to be frightened by some of the volatility that seems to be inherent in this sector. And there's a lot of built-in skepticism and pessimism from mainstream investors as to what's going on with gold and why the price of gold is likely going much higher. Not only are the prior gains justified, but future gains are basically inevitable. And so I think if you keep your eye on the big picture, you could just stay in the trade and use weakness as an opportunity to try to bolster your positions to the extent that you have the added liquidity to do that. And I think ultimately that the whole space is moving substantially higher.
All right, so there's a lot to unpack there, but let's begin with inflation. Inflation's been running higher than 2% for more than 56 months, despite the Fed's best efforts. In fact, it's settled in over 3%, and it's a very low probability it's going to come down to near 2% anytime soon. There appears to be a new normal higher than 3%, and some are calling it purposeful financial repression. What are the implications here of this higher inflation, and are you expecting financial repression as the norm moving forward?
Yeah, well, first of all, I never believed the 2% number. And in fact, the only reason the Fed came up with this ridiculous target of 2% is because they were pretending we were below it. And they were trying to come up with a justification for an inflationary monetary policy. So they claimed we didn't have enough inflation. And so it was their responsibility to create more of it. And they succeeded. And of course, now we're way above 2%, even the way the government measures it. So I don't think we're going to get down near 2% again. And I think at some point the Fed might have to admit that it now targets an even higher level than that. But the significance is substantial for the markets, because if the markets believed that inflation was going to be 2%, and now they believe it's going to be a larger number, whether it's 3 or 4, whatever the Fed says, that has very big implications for how you value assets, particularly gold. Because if inflation is going to be 3% a year, then gold is a lot more valuable than if it's 2% a year, because gold is the present value of all the inflation going forward, all the years, through the end of time, because gold doesn't go anywhere. And so if there's going to be higher inflation, then the current value of gold is much higher than people thought.
I guess the real question is will the Fed ever acknowledge that the higher inflation is going to be the number?
Well, at some point, they're going to look ridiculous if they don't acknowledge something, right? Because they can't keep saying their target is 2%, yet cutting rates when we're well north of that. They're not doing anything to try to lower inflation. Now they try to say that, well, we're still, uh, you know, modestly restrictive. They're not restrictive at all. They've never been restrictive. They're still loose. You could say they're not as loose as they once were, but they're still loose by any, normal metric of judging that, because real interest rates are probably negative if you adjust for actual inflation. But if you look at what's been happening with credit and money supply, they're both growing. And in fact, even though money supply for a while stopped growing, credit never did. So we've had an enormous credit expansion. And there's no way that you can describe this huge credit expansion as restrictive policy. I want to see credit tightening, a contraction in credit. That would be restrictive.
So, Peter, many believe that the Trump administration is pursuing policies to weaken the dollar, and despite the strength that's currently seen in it, they expect it to fall for a prolonged period of time. Do you expect to see a weaker dollar moving forward? And if the dollar is going to fall and investors own gold and silver miners that are in foreign nations, how do you expect those equities to perform in a falling dollar environment?
Well, I think the dollar is going to fall, whether that's policy or not. I think the fundamentals would argue for a much weaker dollar. The policies that Trump is advocating are going to weaken the dollar. I don't know if weakening the dollar is the goal of the policy, but it will certainly be the consequence of the policy. Now, some people think that, well, yes, Trump wants a weaker dollar just to reduce the real value of our debt. And a weak dollar does create the illusion of prosperity because numbers go up, stock prices go up, real estate prices go up. And from that respect, Trump is more about form over substance. He wants to get credit for a good economy, even if it's an illusion. So if it takes a weaker dollar to blow a bigger bubble so Trump can point to a record high stock market, then he's going to do that.
Do you expect foreign equities in the gold and silver mining space to perform well in a falling dollar environment?
Of course. I mean, they've done well in a sideways dollar environment. So I think once the dollar really starts to weaken, that's going to be a big a tailwind for precious metals. I think that as well as they've done against a strong dollar or stable dollar, and I'm talking about relative to our currencies, not purchasing power, because the dollar has continuously lost purchasing power. But once it starts falling, against other fiat currencies, then gold is going to rise even more rapidly, certainly in U.S. dollars, right? Maybe a little less so in these other currencies, but the U.S. dollar price will be rising faster.
So, I'm sure you've heard this, but there's been rumblings that the U.S. is once again working with Russia on a 28-point peace plan with Ukraine to halt the war and to usher in peace. In your estimation, what's the impact on gold if peace is really achieved?
Well, I mean, peace should be a negative for gold, all else being equal, because peace would mean less geopolitical risk. It would mean maybe lower spending by governments and therefore less money printing, smaller budget deficits. So I would think that would be a good thing. As a gold investor, I'm not rooting for war because I think war will be bullish for gold. I think gold's going up regardless of whether we're at war or at peace. So I would just assume that the world be at peace and the hostilities end. But I think all else being equal, that would be a negative for gold. But it's not a big enough negative that it's going to offset all the positives. So I think gold is going to go up regardless of the situation in Russia. But it may go up a little bit less if we have a peaceful and swift resolution. And I would certainly support that happening.
Yeah, I completely agree. All right. So, Peter, the only other time in history where Treasury bonds were in a secular long-term bear market was in the 60s going into the 70s. The stock market rolled over. It didn't have a sharp crash. It did have some scary drops during that time, 30 to 50% range, but it didn't plunge like 80 to 90% like it did in the 20s into the 30s and like it did in 2000 through 2002, presumably because money couldn't flee into bonds for safety. In that 60s and 70s bond bear market, gold, silver, and the equities, incredible historic runs, and they became the main hedge against the plethora of risks during that time, despite the bond market being The stock market really being so highly concentrated and
Yeah.
overvalued with the Nifty 50. All right. So do you view that time period, the 60s and the 70s, with the bond market being in a secular bear market as a good proxy for where things are today and what we should basically expect in precious metals and miners moving forward?
Yeah. Well, first of all, I disagree that we didn't see as big a drop in the stock market during the 70s as we did during the 1920s or
I was talking
1930s, rather.
nominally, not in gold.
1930.
Yeah,
Yeah.
not in gold terms. In gold terms,
Yeah.
yes. Yeah.
But because in both decades, the drop in gold terms was about 90%.
Right.
And so the difference between the 30s and the 70s was during the 20s, we were on a gold standard. And during the 70s, we were on a fiat standard.
Right.
And so against that backdrop, yeah, nominally stock prices didn't go down as much. But in real terms, measured against gold, they went down every bit as much. And in fact, if you look at what happened to consumer prices during the decade of the 1930s, consumer prices actually went down, right? So stuff cost less in 1940 than it did in 1930. I don't know the exact numbers off the top of my head, but maybe 20 or 30% reduction in consumer prices. So stock prices came down, but so did consumer prices. So, from a purchasing power perspective, that lessened the blow. Yes, I lost money in the stock market, but I don't need as much money because the price of everything I buy went down too. But during the 1970s, stock prices came down, but goods prices went way up. And so I think the real losses that consumers and stockholders were subjected to in the 70s were worse. Because not only did they lose money in the stock market, the money they had left didn't buy very much, as opposed to the 1930s, where the money they had left bought a lot more. And so I think the period that we're going to go through now, and that we're going through now, it's been ongoing, is similar to the 70s period, where we don't get a 80, 90% collapse in stock prices. Maybe they go down 30, 40, 50%. Maybe not. Maybe they don't even go down that much in nominal terms. But I expect the decline to be at least equal to in real terms. And that could mean, the same thing in gold. And I mean that the Dow could be worth less than 2 ounces of gold. I think right now it's closer to 11, but it was 45 at the peak in 2000. So, we're down 70% already. And so going down another 20% from there, would make the full 90% decline. It just is taking a longer to get there, but it's happening.
Yeah, and I think one of the things that I really wanted to touch on, maybe I didn't do a good job of articulating it, and the question is that, during the 70s, because the bond market was in a secular bear market, money was not flowing out of the stock market into the bond market. It was really the bond market bear was kind of a hedge, a wall, preventing the money from the stock market to flow out and in over there. Instead, if it was going to flow out, it only really had one way, and that was into gold. Whereas during the Great Depression, it had multiple pathways, and it did go into some mining stocks. Obviously, people couldn't own gold after 34 or 33, but it certainly went into bonds.
Yeah. And, I don't think money is going to be going into bonds now unless it's just the Fed buying them. I think money is going to be fleeing bonds. I mean, from my perspective, bonds are actually riskier than stocks, and that's the irony of it, because bonds are supposed to be the safe haven, the risk off asset, and for treasuries, the risk free asset. But all I see is risk when I look at bonds. And I see two primary risks, or actually three. The normal ones that you would think of would be interest rate risk. Interest rates go up, bond prices go down. But then there's also massive inflation risk that destroys the value of your interest payments and your principal. And clearly, the longer the maturity, the greater that risk becomes. But also, I think the default risk is there. It's not zero. I don't know what it is, but even when it comes to treasuries, there is a real risk that the U.S. government defaults. And that's because the alternative is hyperinflation. Now, we may end up going down that road, but to the extent that we do anything to stop that from happening, a restructuring, and when I talk about default, I mean, I think the odds that the government says you get nothing is probably slim, but it's not zero. Certainly if you're foreign. I mean, I could certainly see the U.S. government defaulting on the treasuries that China owns, or you don't get anything, China. But to the extent that an American citizen owns a U.S. treasury, it might be hard for the U.S. government to say, you get nothing. But, a haircut, 30 cents on the dollar, 40 cents, whatever, is certainly a possibility. But if we don't get that, right, people are going to get a crew cut from inflation. And so there is no way, if you own bonds, the odds of legitimate repayment are non-existent. The debt is so big that there's no way it can be repaid. So the only question becomes, how do we default? Do we do it honestly by, restructuring the debt and paying back less than we borrowed, right? Or do we just inflate it away? But either way, you lose, right? If you're holding treasuries and you hold them to maturity, you are going to lose. There is no chance that you won't. It's a guaranteed loss. So you might as well get rid of them, right? So I think stocks are a much better place to be. Now, of course, all stocks are not the same. You got stocks that have very little earnings or no earnings and have nosebleed valuations, so those aren't going to be the same as a company with real assets that is generating, high returns on those assets and paying good dividends, right? That's a much safer place, I think, to be. And I prefer to get that income and get those values outside the United States because I'm just worried about what's going to happen here. So I try to look for safer havens to invest in equities. But I think bonds are just a one-way ticket to losses.
I have a couple of questions on the markets, but I want to segue real quick with this bond discussion we're having. There's been some talk about the U.S. linking gold in some form to the dollar. Dr. Judy Shelton is one of the biggest proponents of this, and she's been talking about gold bonds. Presumably, if the U.S. did this, they would expect their trading partners to do this as well. And in fact, I heard her say if they didn't, maybe that, we wouldn't do business with them, or maybe they would get a haircut on what we owe them, is what you were just talking about there. But how realistic really is it that the U.S. and other nations will somehow link the dollar and their currencies to gold in some way in order to give them the stability, the strength, the preference that Dr. Shelton has been recommending and advocating for?
Well, I think there are some countries that are more likely to do that than the United States. But the problem with the United States is if we're going to link our currency to gold again, then we can't keep running these deficits because now, the money supply is limited by the gold that we have. So we can't keep running these huge deficits. And so I don't see the U.S. government relinquishing the ability to do that unless it's a real currency crisis. So if the government's back is to the wall because the dollar is in free fall and, the bond market is imploding and it's runaway inflation, might they, do something like, go back on a gold standard? Yeah, they might do it then. But between now and then, I don't think it's the U.S. that's going to do it. But, the Chinese might do it, right? Some other emerging markets that are not running these huge deficits, may look to back their currencies in some way by gold to make them more credible to the market and to replace the dollar. The dollar's role as the reserve currency is going to be lost. It's the process of losing it is already underway. The question is what's going to replace it. And I think gold's going to replace it. But to the extent that currencies can be tied to gold, then that would elevate their stature, I think, within the global monetary system.
Yeah. Okay. So I just wanted to stipulate there that, a full backing or going back to a gold standard, that I don't think that is even what Dr. Shelton is proposing, but some quotes around it. Some type.
Well, I don't know
linkage.
what is she proposing. I mean, maybe she's proposing that we link the principle of the bond repayment to gold. But the
Yes.
only reason to do that would be because nobody wants to buy our treasuries
Right.
without that. And, they already have something called TIPS, right? Inflation protected bonds. And I've never liked those because I don't trust the CPI. And I have a feeling that investors wouldn't trust it either. But if the US government has to promise to repay gold instead of dollars, it's because people have finally lost confidence in the dollar. And that's the only way for us to have a lower rate of interest would be if we promise to pay gold. But the problem is we've already been down that path and we defaulted the last time. All of the dollars were obligations to pay gold and we defaulted in 1971. So if the US government is in such a dire straits that nobody will loan it money unless it promises to repay in gold, I wouldn't put any faith in that promise. How you going to force the government to keep the promise? It's not like you could sue them. They have sovereign immunity. So the government says, we're going to repay you in gold. But when comes time when the bond matures, sorry, we're not giving you any gold. What are you going to do? We're giving you paper. Because
All
if
right.
the
Well,
gold has gone wet, if I loan the US government $1 million, right, when gold is 4,000 an ounce, and when it matures, gold is 20,000 an ounce. You think they're going to give me my gold? It's not. They're going to give me back the paper and say, forget that. That was a bad idea. We're not going to do it because you can't do anything. So that's why I don't think it's even going to happen, because to the point that we get so desperate that we have to make that promise, who's going to believe it?
I think that's a fair point. All right, so let's go over to the markets for a moment. The volatility in the markets is spiking today, but it's been spiking for quite a while. It was hovering down in the low, I don't know, between 10 and 15 for like a year to 2 years. And now it's spiking today. It's up like 11%. Why do you suppose the markets over the last month or so are spiking in terms of volatility the way they are?
Well, today seems to be a huge sell-off. And I even spoke about it on my podcast yesterday, and here it's happening, that I thought maybe what was happening in crypto was just kind of the tip of this iceberg, that it was just a general risk-off appetite, and people were taking their chips off the table. And it started in crypto because it's the most vulnerable because of the complete, speculative nature of the thing. There's no substance at all. It's just a massive mania, and it has even less liquidity, real money beneath it. And so the crypto bubble started to deflate first. And I even said yesterday on my podcast that we'll see what happens today. And I turned out to be right with the NVIDIA earnings. I said that could be a catalyst for a buy the rumor, sell the fact. And I saw last night that crypto was rising, Bitcoin was up, but I said this is not going to last because I don't think that risk on means back into crypto. But I wasn't
But
even
it was
sure
a
because
massive reversal today. It was up like the Dow was up like
oh,
600 or something.
well, yeah. Well, look, NVIDIA was up 8%. It's negative. Everything. There were a lot of stocks were way up this morning and they've turned negative. So a lot of profit taking. This could be a very significant reversal day. There could be a lot more downside to come, particularly crypto. But if the AI bubble, if the air is going to come out of that thing at the same time that it comes out of the crypto bubble, I was surprised. Even gold stocks, and they're still way down on the day. Gold never really went down very much, and now it's positive. Yet gold stocks are still down 3 or 4%. So it's throwing the baby out with the bathwater. There's a lot of just liquidation going on right now, which to me shows problems in the system here. Look, there's liquidity problems going on right now. And of course, if the Fed comes to the rescue by adding liquidity, gold's going to go on a moon rocket.
Yeah, it seems like Powell's not so eager to do that. But let's stay on the AI front here for a second, Peter. Microsoft, NVIDIA, and Anthropic. I'm sure you've heard of them. They're an AI startup that's just a few years old. They just completed a multi-billion-dollar deal. It valued Anthropic at $350 billion. Anthropic's founder, Dario Amodei, he's been on many interviews over the last 6 months. He's saying that most startup level white collar jobs in law, technology, medicine, et cetera, they're going to be gone to AI within 5 years. There's so much capital that's being thrown at AI from every angle. It's unlike anything we've ever seen. It just keeps going higher. I'm saying AI is going to either eat the world and be the greatest destroyer of jobs man's ever seen, or it's going to be the greatest destroyer of capital man has ever seen. Either way, the risks are extremely high. Don't we really need to be hedging this?
Well, what I was saying on my podcast last night is I can see all the money, all the capital going into AI. Where is it coming out of? Right. So no one is asking, what sectors of the economy are losing resources, capital, in order to free them up to go into AI. And what are the consequences going to be there? Right. Because it's a trade-off. It's just not coming out of heaven. Right. We have to give up something. Right. What's not getting funded? What are we not doing? Where are we going to see a big problem because of a lack of capital? Because it all got shifted into AI. That's one of the things I'm concerned about. Look, I think AI has tremendous potential. I think, however, the rush to build this out, these hyperscalers, they may be way ahead of where AI is going to be, and how long it's going to take to really implement it on that big a scale. I'm not worried about eliminating jobs. I mean, I'm all for that. I mean, it's not so much jobs I want to eliminate, it's work. It's the need to work. Ideally, humans won't have to work at all. And I'm sure at some point in the future, humans won't work. We won't have to. We'll have machines that work for us and think for us, and they'll do it better. They'll do it faster. They'll be stronger. And humans, will be able to have more leisure. They'll be able to do things that they enjoy because we won't have to struggle to survive. Now, of course, we don't have to struggle as much as, the cavemen did, right? I mean, look at all the work. I mean, if you were a caveman, you probably worked every day from, the moment you woke up to when you went to sleep until the day you dropped dead, right? All you did was work, and you didn't really have much to show for it. But now we don't have to work so hard, right? Once upon a time, half of the people were farmers. We had to spend half of our population was needed just to grow the food for the rest of us to eat. But now, what couple of percent can handle growing the food for everybody, right? Because we have productivity that put farmers out of work. And it's a good thing that so many farmers lost their farming jobs because now they were freed up to do other things. So, I'm more interested in all the things that we get freed up to do, not the work that we no longer have to do. So that's a positive.
Can I interrupt real quick there? The one concern that I have on this, and I just wrote about this in my Substack, if we do get to this point, this Elon Musk moment where we are freed up to enjoy life, aren't we so dependent on two very key entities, both the tech oligarchs and the government, to do the right thing and to give us the kind of salary that we're going to need in replace of our jobs? No. Isn't that a risky proposition for us?
No, nobody has to give us anything, right? In a free market, we earn what we get.
I'm saying if all the jobs were taken up, if all the jobs are gone.
But if all the jobs can't be gone, right? Because there's always something that needs to be done, right? And if there's nothing that needs to be done because we have everything, right? So then, if I can have everything, okay, let's say that AI comes up with a little device, like we all have like a cell phone, right? And maybe I buy this one thing and it gives me whatever I want. I ask for food. It gives it to me. It just creates it out of thin air, right? If I want a house, it creates it. If I want to, I can get everything I want, everything I need just by pushing a little button on it. What the hell do I need a job for? I just need somebody to fix this phone if it breaks, but I can get everything that I want.
But the cost for those supply chains and everything that go behind that. All right, let's move over to gold here. What is the resilience shown by gold and silver over the last month since that 6 sigma drop a month ago, despite many calls of the top and the demise of the precious metals? What does that all say to you?
Look, it's amazing that people talk about how gold's in a correction. It's almost $4,100 an ounce. All that happened was gold had about a week where it just kind of ran crazy, where once it got up to 4,000, it quickly ran up to almost 4,400, and then it pulled back to 3,900. Big deal. You barely notice it. If you closed your eyes for a few days, you didn't even notice anything happened. So, silver, I think, is even more significant. Silver's been trading above 50. It's, almost 52. That was the double top. That was a huge wall of resistance from 1980 and 2011, And we went through it like a hot knife through butter. Yes, we pulled back. So what? This is a pause that will refresh the next leg of this huge bull market. We're headed up the 5,000 pretty quickly. Once we really start to move, next year we could hit, easily hit 6,000, not just 5,000, 6,000. And I would not be surprised to see silver double, right? Would be $100 silver, and see it next year. But I mean, that's inevitable at some point, but we could see it as early as next year. But $100 is not going to be the top for silver because there's no floor. You're going to need a lot more dollars to buy everything, especially gold and silver.
I'm sure you saw it, but the portfolio managers, the bankers survey where 0% said 6,000 is in the cards, and only 4% said 5,000. It seems like, you have 4% of these folks who all of them missed the doubling in gold. None of them were recommending gold when it went from 2,000 to 4,000 over the last 18 months. None of the issues that drove that doubling over the last 18 months have been resolved. And yet here they are all saying, 0% it's going to 6,000, 4% it's going to 5,000.
Yeah, it's actually worse. I remember in early 2024, you had these big investment houses were downgrading basically to sells, Newmont and Barrick. And the reason they gave for the downgrade was just a call on the price of gold. So gold was about $2,000 an ounce. And they all said that they saw no upside from there, that there was just risk of the price of gold falling. And therefore, there was no reason to own these gold mining stocks because all that you could have was be disappointment because the price of gold was going to go down. So they said, because of that, we're just going to put sells on these stocks. And of course, the price of gold proceeded to double from the point where they said it had no upside. And, obviously the big driver of the gold rally has been central banks. And that's going to not only continue, it's going to broaden. More central banks are going to start buying, and the ones that were buying are going to buy more because all the central banks who bought gold have been rewarded for those purchases. Gold has gone way up. And in fact, now gold outnumbers treasuries. So gold is now a higher percentage of central bank reserves than U.S. treasuries. And it's been decades since that was the case. Yeah. And this is going to continue. But what's going to happen is that private investment is going to pick up, particularly in Europe and North America, where it's been very sluggish. There has been very little investment in precious metals from an investment perspective. Sure, I mean, people buy gold jewelry or but they don't buy coins in bars to hold it as an investment. That's going to change. That is changing now slowly, but I think it's going to really pick up next year. And so that's going to accelerate the price increase because it's going to be central bank buying continuing, but now private investor demand really adding to it. And
for that to happen,
the supply going to come from?
For that to happen, does that require the stock market to drop, or do you see a scenario where the stock market could either remain where it is or continue to go higher, and folks also move into gold and silver?
Well, look, it helps if the stock market is falling, right? But even if the stock market is trending sideways or going up slowly, look, gold is up over 50% this year. So even if you're up 15%, 20% in stocks, you're better off in gold. And if that continues, people aren't going to not notice that. That, right. Yes, I have more dollars, but my stock portfolio is worth fewer ounces of gold. And if they start to realize that their cost of living is rising faster than their stock portfolio, but not faster than gold, they'll recognize that it makes sense to own more gold and less stocks. But I think what's really vulnerable is the bond market. And in fact, when you look at what Morgan Stanley, this is a couple months ago, but when they tweaked their 60-40 portfolio, they didn't reduce the allocation to equities. They cut in half the allocation to bonds. So they didn't say sell stocks and buy gold. They said sell U.S. treasuries and buy gold. So the problem is the bond market, right? And if bonds are being eaten up, because people buy bonds for safety, But if the interest rate is not high enough to offset what you lose to inflation, gold is the alternative. So it's the money coming out of the bond market. That's where you should be really paying attention. Money leaving bonds and going into gold is far more likely than money leaving stocks, because at least stocks, the right stocks, offer an inflation hedge. They offer a dividend yield that can go up. The coupon on a bond is fixed, right? So if there's a lot of inflation, well, I own stock, they could raise prices and now they can pay a higher dividend. But, you buy a bond with a 4% coupon, prices double, your coupon stays exactly the same. And so there's the risk. So it's a bear market in bonds that fuels a bull market in gold much more than a bear market in stocks.
Agreed. All right. So let's play this out. So let's say gold does go to 8,000 or 10,000 over the next couple of years, and silver goes to 100 or higher, 150, 200. We hear a lot that people don't want to live in a world of $10,000 gold and $100 silver. Do you agree with that perspective? And what kind of world is it if it's $10,000 gold and $100 silver?
Well, I mean, that's the world we're headed to. So if I don't want to live in it, that means I have to die. So I want to be alive in whatever world we have. But look, I mean, gold was $20 an ounce, for 130 or 140 years. And it was $20 an ounce when we created the Federal Reserve. So now it's gone from $20 an ounce to 4,000. I mean, people probably would have thought, oh my God, back then, what would the world be like if gold was $4,000 an ounce when it was just 20? So, inflation is going to be bad. Yeah, I mean, but whether it becomes some kind of apocalyptic Mad Max type in situation, I mean, there are a lot of countries that have gone through massive inflation, Argentina, Venezuela, Zimbabwe, and those are like hype, so what's, gold there went to millions or billions or trillions, whatever it went to, right? But look, I don't think gold's going up to that price because of some kind of, military, crisis. It's just going to be the dollar and inflation. And, if the dollar loses 90% of its purchasing power, that means gold has to go up 10x just for that reason alone. And so that means from 4,000 to 40,000. And if the dollar loses 80% of its purchasing power, gold goes up 5x, and that puts it at 20,000. But I think that if we have a dollar crisis, gold's not going to go up nearly that much in the rest of the world. It's going to go up a lot in America, but in other countries, not nearly as much, because their currencies are going to rise a lot against the dollar. That means the gold price won't go up as much there as it will here. But a lot of it depends on how the government reacts to this crisis. If we go all in on socialism, if we elect a outright, Marxist type socialist president and Congress, and all of this gets blamed on capitalism, yeah, it's not going to be a good world here in America. But it's not going to be because gold went. It's not going to be because of what gold did. It's going to be what we did as a consequence of it.
Yeah, I think it's a real possibility if they don't fix it. Yeah.
Yeah, rather than learning our lesson and atoning for these mistakes and correcting them and cutting government spending and deregulating and doing all the things that we should have done, but we never did because there was too much short-term pain. Once the short-term pain is so excruciating that all right, now we might as well solve the problem, because there's no point in trying to avoid the pain. We got it. We got it in spades. Yeah. But, in that kind of environment, right, look, Adolf Hitler came to power in part because of the hyperinflation during the Weimar Republic. Had they not had that, maybe the Nazi Party wouldn't have been able to gain the type of support that it did. Because remember, the Nazis came to power democratically. They didn't have a violent revolution, right, to overthrow the Kaiser, whatever. The people voted for that.
Yeah,
And
I agree
so,
with you, Peter. If they don't, if this current administration can't fix, what's happening, it'll probably go to the extreme left for the next one to
and we're
try to.
not even on the extreme right. That's the problem. Most
Yeah.
of what Trump is proposing is left-wing programs. It's socialist, big government central planning. It's attacking the free market. Yes, he is pro-business in a sense, but so is Mussolini, right? Yeah, he was so pro-business he wanted the government to run it and control it, right? I mean, that's why he called fascism corporatism, right? Government and the corporations working together. And Trump is trying to work very closely with companies. I don't like any of this. I don't like.
All right. Well, let's shift over to silver real quickly here. What does it mean to you, Peter, that the silver deficit is still here after 5 years, and despite silver being at $50 now?
Yeah,
What
look,
are
it's
we looking at here?
surprising. It's surprising that silver is still this cheap. Especially given that gold is 4,000. So you know, that's why I've been pushing silver. I've been telling people, my company Schiff Gold, buy silver. I know the name is Schiff Gold, but buy more silver than gold. I've been saying that now for the past year, that people should be, really looking at silver, because it didn't make any sense that it was so cheap.
Do
And
you see do you see a significance between in the same week the US adding silver to the critical minerals list and at the same time China stop halting exports of silver out of their country? I mean, is there a significance there, and is there
probably,
ramifications? Is there
probably,
ramifications of that?
yeah, probably. If China knows that we want it, they don't want to supply it. I mean, we've basically declared war on China. I mean, not a hot war, but as a form of Cold War, trade war. We've claimed that they're our enemy, that they're ripping us off, and that's a dangerous thing to do. They've been supplying us with goods and loaning us the money to buy it. They're our biggest supplier and our biggest banker. And we're telling them that they're screwing us over and that they're our enemies. Not a very good strategy.
Well, this has been an exciting discussion with Peter Schiff, founder of Schiff Gold and Euro Pacific Asset Management. Before we wrap up with the final question for Peter, I want to direct everyone interested in the metals and miners section to dive into our Substack at metalsandminers.substack.com. Join the quickly growing community and receive a free report. It's titled, "If You Don't Own Gold, You Know Neither History Nor Economics." That's a famous quote by investing legend Ray Dalio. That's also the name of the report you'll receive. I'm also positive that you've been enjoying this conversation that we've been having. Please let Peter know, hit the like and subscribe button, and leave a comment below the video. Peter, let's finish up with you sharing a key takeaway that you want the viewers to keep in mind about today's situation that we're seeing, and then let everybody know where they can learn more about your work and how they can connect with you.
Yeah. Well, again, there's really only one way that this can end for the metals, and that's at much higher prices. And eventually, as people start to understand, they're going to be buying these gold mining stocks, the silver mining stocks. I mean, the outlook has been way too pessimistic for a long time, because the mainstream analysts that cover these stocks don't understand the monetary situation. They don't understand inflation. They don't understand fiat money, central banks, economics, you name it. They're pretty much ignorant of it. And so, that affects their coverage of these stocks and how they recommend them to their clients. I think that's going to change. People are going to start to appreciate what central banks obviously have already figured out, which is why they've been such big buyers. But yeah, if your audience is interested in the miners, we have separately managed accounts at Euro Pacific Asset Management that focus specifically on precious metals mining. I think there are tremendous opportunities there, especially in the junior companies. And the key there is to avoid the landmines and just get the gold mines. A lot of people don't know the difference. Adrian Day does, who is managing these strategy for us. He's been at this for like 40 years. He's probably forgotten more about mining than most of these analysts know. And he knows the projects. He knows, the management teams. So it's hard to fool him. If you got some BS story, right? What's the definition of a gold mine is a hole in the ground with a liar standing next to it. Well, it's hard to lie when you're lying to Adrian, because he's heard them all before. So, and that's also why he manages my gold fund. And we've got some great stocks in there that the market doesn't appreciate yet. We've underperformed the benchmarks over the past year because the rally has been concentrated in the bigger names, and we own those too, but we also have a big allocation to the real small ones. Those, I think, are the sleepers. They're going to make, I believe, a much bigger move next year, and that's going to be what's going to propel significant outperformance for our fund. So if anybody wants to get in on it now, I would advise that you could buy it no load. The symbol of our gold fund is EPGIX. That's the no load symbol, EPGIX. You can get it at any discount broker. Also, I've just launched a new company. For now, it's part of Schiff Gold, and it's T-Gold, tgold.com, and the T stands for tokenized. And my plan is to eventually have a gold token. There are already a few of them, so I'm just going to have my own branded token. But in the meantime, I'm starting the infrastructure, and I'm building up the ecosystem. And so if you want to start buying gold and silver now, that can eventually be withdrawn in the form of a token so that you can negotiate it, you can transact with it on an exchange, or you can send it peer-to-peer. You go there now and open your account, and you could buy either gold or silver in any denomination, buy $100 worth, $1,000 worth, $10,000 worth, whatever you want. It doesn't have to be a specific quantity because, you'll get whatever quantity the dollars happen to buy at that moment. But we store it for you, no storage costs. The cost of buying is barely above the spot price of the metals. So, you're getting a lot of gold and silver for the money. You can trade out of it whenever you want. You can withdraw dollars whenever you want. So it's a great way to hold. Eventually, I'm going to have debit cards, credit cards linked to those accounts. I'm going to do all ways to expand the platform to make it easy to use gold as a medium of exchange. So it's not just a store of value. We're using it the way it was intended to be used, as money, to satisfy all of those criteria: medium of exchange, store of value, unit of account. Because what we got now just doesn't work. Dollars, euros, yen, they're no good. And so gold needs to be reintroduced as money. The central banks are reintroducing it to back up their currency, but individuals should use it as well and opt out of the fiat system and go on their own gold standard. So I'm doing that at tgold.com. And again, I'm doing my own podcast, the Peter Schiff Show. People should listen on my YouTube channel or wherever, you have podcasts, iTunes, Schiff Radio. We do it. I also at Schiff Gold now, I do every week. I do the Friday market wrap. I'll be doing one tomorrow. I got a newsletter now, Schiff Sovereign. Free newsletter. Just got to go to Schiff Sovereign and subscribe. We also have a paid letter that comes up with a lot of interesting research on, small mining companies around the world. So if you want to get another source of information about that, you could, subscribe to Strategic Assets. And if you don't like it, just ask for your money back, whatever you want. It's got a full refund guarantee, but we do some excellent research there for people who want to do it themselves. You can hire me and just buy my fund, or you could, get some of my research and do it yourself. And then follow me on social media, subscribe to my YouTube channel, follow me on X. I'm constantly posting on X. That's where I put a lot of, my thoughts on what's going on in real time. Every once in a while, I do a space and I just start talking. And so make sure and follow me there.
Wonderful. I'll have all that information up on the screen. It'll also be in the description area for everyone to click through. Peter, thanks for coming on to Metals and Miners again, for being so generous with your time, analysis, and ideas. Yeah. It's always fun to spend the time with you. I look forward to having you back on sometime soon. And everybody else, thank you for watching. To dive into our Substack at metalsandminers.substack.com. Join the quickly growing community and receive a free report. It's titled, "If You Don't Own Gold, You Know Neither History Nor Economics." That's a famous quote by investing legend Ray Dalio. That's also the name of the report you'll receive.